Today, I'll discuss top 5 financial traps which need to be avoided for a better future. Number 1, credit card. Are you getting messages and calls on regular basis from credit card companies and banks? They are offering you credit card with credit limit up to 3 to 6 times of your monthly earning, or you are already having a credit card and banks are asking you to get another. Sometimes there might be situation that you purchase something from store or online shopping app, and at the time of payment you are offered to convert your payment into no cost EMI spanning over 6 to 36 months. Credit card is designed with attractive feature to manipulate your spending habits. You might find yourself spending more often after having credit card. For majority of people, credit card provide little to no advantage. Disadvantage of having credit card always outweigh advantage. The only advantage it provides is it increases your purchasing power, burn your earning and means. You purchase goods with your future income. When you buy with your credit card, you need to pay back the money within due date. If you miss the due date for repayment, the banks start charging you interest. Suppose you spent 50,000 rupees from your credit card and fail to pay the full amount back on time. The bank shall charge interest which may go up to as high as 48%. You will then be responsible for paying back the original amount plus whatever interest or penalty have been added on. The interesting thing is banks make little money from responsible customers who pay back quickly and regularly. Banks get only merchant fees and chargeback from such transactions. That's why they try to manipulate your spending habits until the time you convert your payment into EMI. How they do this will be discussed later. For now, let's look at what is merchant fees and who pay for it. When you make a payment using your credit card, the entire amount does not go to the seller. Roughly 3% of the transaction amount is charged as card processing fees from the seller. For example, suppose you purchase a good or 100 rupees from a retailer and make payment using your credit card. The seller shall receive 97 rupees out of 100 rupees and the card issuer bank shall receive 3 rupees as merchant fees or processing fees. A seller will never make loss by absorbing the merchant fees himself. He passes on the charge on purchaser by preloading the cost on the product or by leaving convenience fees separately on the purchase. For example, if the actual price of a product is 100 rupees, the seller shall increase the price of the product to 103 rupees for credit card user to keep his profit intact. You may also find the retailer sell it on actual price of 100 rupees but charge a convenience fees of 3 rupees separately on the sale. Either way, it is you who is paying the merchant fees. Let's take a look how our spending habit is being manipulated. Credit card basically inculcate a habit of overspending on the most of the users. This is due to purchasing power being increased beyond your earning. Sometimes you may end up spending entire monthly income plus entire credit limit of the card in quest of improving lifestyle. Whatever our present lifestyles are, we always compare it with our friend, neighbors or someone enjoying better lifestyle than ours. To keep up with them, we overspend by taking even multiple credit cards and personal loans. At the end of the day, you have to pay your credit card bills. This way, you may end up with loan burden which is beyond your repaying capacity. Once you defaulted in repayment, credit card companies shall charge interest as high as 48% on the defaulted amount. To repay credit card due, you may require another credit card or personal loan, which is a sure sign of vicious cycle of debt. Let's take a look at how people fall into such situation. Suppose your monthly earning is 1 lakh rupees. You will most probably be offered credit card with limit up to 2 to 4 lakh rupees. In the course of use, your credit card limit will be kept increasing until the time you make big purchase with your credit card which you cannot afford to repay within due date and compelled to convert the purchase into EMI. which bear abnormally high interest, and that is what your credit card company want. The main purpose of credit card companies is to collect interest from cardholder. They cannot earn interest if you pay within time and regularly. That's why they want you to spend twice or thrice the monthly earning in one go, so that you convert the bill in EMIs and pay high interest. Credit cards business has been growing rapidly with year-on-year growth rate of 33%. The banks and NBFC which are in credit card business are making huge profit. When there was no credit card, people used to pay from their savings and used to be cautious with their spending. With the advent of credit card, people are spending recklessly and paying hefty interest and many other charges associated with the card. So don't overspend your credit limit. Better if you don't use credit card at all. Number two, personal loan. Personal loans can also make you go bankrupt if you take it for general consumption purposes, like expending on tour and travels, purchasing unnecessary household goods, partying in an expensive hotel, etc. Personal loans bear high rate of interest ranging from 12 to 20%, which is quite high and may dent on your earning. EMI for personal loan remains quite high since the tenure of the loan is short. Banks generally offer repayment period up to 5 years. Some banks may offer up to 7 years, but not more than 7 years. You should take personal loan for purchase of assets whose value always appreciate at the rate of 12% and above per annum. Since you have to pay interest to the bank at the rate of 12% or more. For example, if you are purchasing a land in a developing area, then it can be considered as a asset whose value will be appreciate over time. However, you can also take personal loan for compelling situation like medical expenses. Since most people once in their lifetime takes home loan for acquiring houses, taking personal loan and home loan simultaneously makes your bad financial health go worse or even you may bankrupt. Personal loan is the most profitable product for banks since it collects more interest than their other product, and it may cause financial constraint on those people who took it for trivial expenses. So never ever take personal loan for travel expenses or for purchasing non-essential goods. Number 3. Are you taking home loan for purchasing residential flat? It can also make your financial health bad or you may even lose money. Do you know there is much better option available to you? When it comes to purchasing house, you must first look at the option available for purchase of an independent house with land or purchase of land and construction of your dream house there. Of course, it should be within your budget and without squeezing your purse too much. The most important thing is land, not the house. The value of land never depreciates, but the value of house will depreciate over time. However, cost of land in big cities are too much and out of budget for most of the house buyers. In case of big cities like Mumbai, Delhi, you may choose to purchase flat, but you should not invest your whole savings plus maximum available bank loan. Nowadays, banks are ready to offer home loan up to 70 times of your monthly earning. You should not take loans more than 25 times of your monthly earning because in reality, after 10 years of use, flat needs repair. And after 30 years, flat are normally not in a habitable position. So, if you are purchasing flat, your next generation cannot live there. After 20 years of use, value of flat shall be substantially depreciated. However, in the initial 10 years, the value of flat might keep increasing depending upon location. Taking huge loans and selling out whole of your savings for purchase of flat is nothing but disaster. Let's take an example. Suppose you are having monthly income of 50,000 rupees. You have decided to purchase a 2 BHK flat which is priced at 45 lakh rupees. Adding registration fees, it shall cost you around 48 lakh rupees. Now you approach your bank for loans and banks approved you a home loan of rupees 35 lakh for 20 years. You have savings of 20 lakhs and sell out 30 lakhs as your own contribution for the purchase. Now flat is yours, but you are now having long-term obligation of repayment of the home loan. Your EMI will be around 31,000 rupees. You are left with only 19,000 rupees for your household expenses. With this leftover money, you will find yourself in a very tight financial situation. Managing your household expenses will be very difficult, let alone savings for the future needs. This is the time people tend to accept single or several credit cards to cope up with the household cost. This way, the vicious cycle of debt kickstarts. In case of land with building, the value of land will never depreciate. If you are lucky enough, value of your land may increase many folds. Investment in independent house is always better, but you should not invest whole of your saving plus maximum possible loan. It may cause severe financial stress. Number 4. Are you saving every month for creating an emergency fund, or you have already created an emergency fund equivalent to at least 7 times of your monthly earning? In both cases, you are shielding yourself and your family from a possible future risk. An emergency situation may arise anytime to anyone, like medical emergency. So you need to keep a fund ready to cope up with such unforeseen situation. The fund should be liquid enough that it must convert into cash within an hour or so. Preferably, the fund should be created in the form of bank savings deposit, which is more liquid than anything else. You can use the money whenever the situation demands. In case you have not created such fund, it may cost you heavily in case of emergency. Number 5. Are you investing your money after duly assessing associated risks and rewards? In most of the time, you don't make an independent assessment of risk whenever you invest in share market or mutual fund. You prefer to transfer the job of assessing to fund managers. That's not good at all. Let me tell why. There are a lot of investment options available to you. Investment in bank fixed deposit, post office savings deposit, gold, and government bonds are considered safe. You don't require risk assessment for investment in such financial instruments. To get better return, we often invest in mutual fund or share market. There is a sea of options available to the investor investing in mutual fund and share market. From low risk, low return to very high risk and very high return. Here you can lose your whole investment, or you may earn multiple times of your investment. So whenever you turn to share market or mutual fund, you must calculate the risks. Investment without calculating risks may end up losing a whole lot of money, or the investment become illiquid at the time of your needs. So don't take any financial decision without comprehensively assessing its risks and benefit.